When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shea, and as always, I'm just here to ask the questions with the words of wisdom and solid advice. Of course, they come from the other Jeff in this radio program. It's Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how are you doing today?
Doing great. How are you doing?
I'm doing great, thank you. Saturday after Thanksgiving. Did you have a nice Thanksgiving dinner?
Of course. It's always good. I try not to eat as much as I used to in the old days. I used to get those food comas afterwards and die, but this time I actually stayed awake long enough to watch a little football. So,
well, Thanksgiving's always a great time of the year. I enjoy the food. I enjoy the company, but then I'm glad when everybody goes home and I can enjoy the leftovers here for the holiday weekend. Of course, Thanksgiving is behind us now. The holidays are here upon us once again. Christmas is just around the corner. So anyway, a lot to talk about on today's radio program, Jeff. And we're going to start off by talking about whether or not it is the most wonderful time of the year for the stock market. Of course, Andy Williams recorded that song back in about 1963, and the S&P 500 was singing a bullish tune of its own that year. But what about historically this time of the year, Jeff? Is the stock market really considering this the most wonderful time of the year?
Well, often it is. They sometimes near the end of the year is when Wall Street gets all their bonuses, and a lot of companies get their bonuses. Many companies are tied to their own stock and give their own executives or board members bonuses. You know, board of directors typically are big shareholders. They call it window dressing sometimes in the mutual fund business, where mutual funds want to take profits on some things and lock in some gains, or they want to maybe sell some dogs and actually buy a ton of stock that's in their portfolio, big positions, and actually drive the price up so they increase the net asset value of that fund to make it end the year on a good note. Most companies actually report their earnings on a calendar year basis. So if we're already starting a good year, looks like we're having a great year, it's very unlikely, barring some sort of a political move to try to ruin Trump's incoming presidency or something like that, could happen. Or firing missiles off into Russia, could happen. And there could be some catastrophic events or even black swan events that could happen between now and the end of the year. But, barring any of that, typically the end of the year is a decent time to invest in stocks. The other thing is we know that there's certain months that are typically bad. September's not particularly a good month. Most of the big crashes or corrections have happened in October. This October wasn't particularly good either. But, November after the election, we got a strong bump, the Trump bump. It's been a little choppy. We had a little bit of softening right after that to find direction. And then, some of Trump's picks, for Treasury Secretary and some other things, I guess made Wall Street feel comfortable. Investors feel a little bit more comfortable about, staying true to the investment course. So I think this year, again, barring any unforeseen events, and we haven't seen anything super catastrophic at this point, materialize other than, the missiles in Russia thing does bother me. The fact that Israel still hasn't figured their deal out, in that part of the world. And, I don't think there's any leadership on our end that's going to do anything good, bad, or indifferent about it. They're just kind of being, kind of lame duck, I guess you could call it, other than the fact that they're, sitting back and letting some of these foreign powers do what they want and maybe even, stir up some trouble. I don't know if there's anything going to be really rocking the boat because everybody's just assuming that Trump's going to come in and, with his magic wand, just fix everything. They're still not huge earnings. Some of the earnings, in some companies are getting better, but they're still not robust enough to justify 30 and 40 and 50 price earnings ratios, or an average S&P price earnings ratio of 35, which is unprecedented as far as how high it's been in history. It's only been close to this twice, but it's been relatively high in the 30 plus range a few times, and every time it's right before a crash. The biggest ones being the 1929 crash and the one in the 2000 dot bombs. The market wasn't super overvalued right before the 08 crash, although it was pretty highly valued. The biggest problem with that was just all the shenanigans and the game playing by derivatives and the CMOs collateralized mortgage obligations, writing mortgages for anybody with no qualifications and then boxing them up and pretending they were secure securities. And then the banking crisis blew that up more than just overvaluation. However, we have seen the valuations return to normal. I think right now there's enough emotion driving the market, not to mention the incentives that the companies have near the year end to jump into prop their stocks up, maybe do some last minute buying to make the stock end on a high note so they can show a good calendar year earnings. So again, barring any weird events which would trigger something, I don't think there's going to be a massive change of heart and say, oh my gosh, this is not going to really be as good as we thought. Trump's picking a lot of bozos to be his economic advisors. That's not happening. Trump's saying he's going to ruin our economy by tariffs and all these other things that, really haven't, although they've been little fear-mongering attempts to make him look bad, they haven't done anything to affect the market. So, not that I think that it's ever wise to get into an overpriced market if you can't afford to lose money. I don't think that if you're, gradually getting back into the market or looking at possibly taking on a little bit more risk going forward is, in my mind, even though the market did incredibly well this last year based on manipulation and basically, a bunch of false information. I mean, shoot, they're already revising the jobs numbers again to say that they weren't as good as they were. The economic fundamentals have not been there to sustain this upwards momentum in the stock market. It's only been the manufactured monetary supply being changed around by the Fed, and the Fed and banks are partners. The Fed does not work supposedly at the orders of the president or the government, so to speak. They're supposed to be disassociated. They're supposed to be more of a controlling entity, but they're really used to just prop the banks up and help make the banks rich, and they do it without any rules. They can basically say, oh, you don't have to pay us back these loans. In fact, we'll even borrow the borrowed money back from you. And it's like you're paying interest, 3 different directions, and everybody's get the books at profits, and the banks look stronger than they are. They're able to keep investing money that they don't even have, that's kind of fake money that the Fed generates for them, to buy their own stock, to buy, the stock market in general and prop the market up. So we've seen a lot of manipulation at this point, and I've talked about it all year. But with a new president and new economic focuses, I think we're going to get some value added to maybe support at least a portion of some of the upside that we've received. That doesn't mean that the valuations are by any means realistic or smart to, overpay for the market the way it is. However, I think eventually, and given 4 years, I don't think it's going to be just 2 months after he's inaugurated, all of a sudden inflation is down. We're getting back some of the price increases. We're energy independent, and all that stuff's going to take time. So I think we're maybe a little putting ourselves way ahead of the reality that the stock market's going to end up being in a place where fundamentals actually can support it again. I think the hope is there, and I think, absent of any reason for it to go down at this point, just kind of a wait and see how Trump attacks the things he says he's going to attack, whether the tax increases actually create more stimulus for the economy, if they can cut the expenses of government enough to where it doesn't create, more deficits and problems where they have to spend, but they don't have the tax money coming in. That would be a bad thing. Tariffs could be inflationary, but I don't think they're as big a problem as people say because they actually have some benefit added to them. We can talk about that if you want later. But, I think by and large, we might have the Santa Claus rally that we're used to. I don't know how much left there is. I think this Trump bump and, what we've already got right after the election might be a lot of it. It might be all of it. I don't know. My gut doesn't hurt thinking like we could have a crash any minute, honestly, like it did right coming up to the election. You just never knew, and if the election would have gone the other way and people would have been, scared of the Harris tax increases plan and some of the, harmful things that, her agenda implied to the markets and to economy, I think, Wall Street might have reacted a little bit differently, but that's at least behind us. We've got looks like a stable transition, hopefully. I still am not, I'm not clear of the line of thinking that the Democrats could do something just to try to mess up or make Trump look bad or make the economy that he's inheriting look back or do something that they could blame him. They seem very vindictive, and I'm just calling this like I see it. I don't know why it has to be that way, but it seems like the parties have been so separated and focused against the other party rather than let's see where there's a middle ground where we can work together and compromise like was back in the day, decades ago, back in the Reagan days maybe. But hopefully we'll cruise into the end of the year. We don't have to mess up our Christmas with a market crash.
Jeff, you had mentioned a moment ago that in your opinion, the market is overpriced. Considering that, are there opportunities that, even though you consider the market overpriced, that exist here in December that may not exist otherwise?
Yeah, I don't know that it's a seasonal situation that would exist otherwise. I think there's some sectors of the market that maybe, have been forgotten. I mean, I was just looking at some things like I saw a report on robo-taxis, drone taxis, not just the robo-car taxis and things like that. And so you're seeing certain sectors of, anything that has to do with drone technologies going crazy right now. I mean, there's some things, there's always these little nooks and crannies of opportunity that you might be able to go into that have been kind of forgotten because they've been kind of shelved because AI has been everything. I think AI is kind of sorting itself out. Many people are finding out that AI isn't quite as intelligent as they wanted to. And I think the going forward, if you look at the kind of the marketing cycle, it usually starts with hype. Then it comes into kind of the reality of who really needs this, who really can use this, and what the market really entails, rather than just assume every market and every business on the planet needs it and can use it. I think we're going to sort that out, and I think AI is going to soften, and we're going to find those winners out of that business. It was, a year ago or 2 years ago, you can buy anything that had an AI focus on it, and it was going to go to the moon. Same with .coms, back in the 90s, but after that was done, there's only a handful of companies that emerged winners. There's always these new technologies, and I guess if you're aggressive and you want to keep seeking those out, you can find them. But right now, we're seeing the dollar strengthen, because America's, the hope of America and the new Trump administration is going to fix a lot of things. So the dollar's getting stronger, which makes gold weaker. So that's not a very good investment right now. It was really good up until the election. It's been a little soft now. It bounced a bit for a minute, but I don't think it's going to keep its strength too much longer. It might rebound again when we find out how weak the economy really is and how much it really needs to be fixed once we find out that Trump doesn't have a magic wand and can't fix things in an instant. But I think things will sort itself out. I do think that, the banks, even though I think they've been propped up unnecessarily and unwarrantedly in many ways, will probably continue to be propped up. I mean, it takes banks to make the economy roll. So I think the favorable environment of a Trump administration will probably help banks more than hurt them. Energy is going to be one that, we've already seen grow just based on the hope that, we'll become energy independent. The interesting thing is usually if we're energy independent, the price of oil might actually go down. So, that might hurt profits to some companies, but then again, the drillers and the infrastructure companies might profit. Bottom line is there are certain sectors of the market that I think, in spite of the overvaluation, will see such a strengthening of the economic underpinnings of that industry or that sector of the market that I think we'll see some pretty good upside. I think pharmaceuticals might be a place where you think Trump's going to be a lot more skeptical about free vaccines and all the crazy stuff that everybody did during COVID. And I think we're already seeing that in the market. So, I mean, there are some trends just based on the election that we know are probably weak trends, and we know some that are strong trends. I think if we try to focus on those, we can be a better investor if we want to enter the risk markets at this time. And many people are just saying, you know what, we did okay last year. We didn't lose any money. We're up, better than inflation. Let's kind of wait till the inauguration, make sure something doesn't happen, that there is, in fact, a peaceful transition and we're not involved in World War III between, Russia and Ukraine and all this stuff. So maybe another month will play out before, we get super comfortable. But, some of our clients are already saying, yeah, let's wheel our way back in and try to take advantage of some of these sectors that look like they're stronger and going up. Some of the retail companies are doing great. Walmart's doing great. Some of the retail companies are doing horrible. Target's doing horrible. You have to be kind of a very picky stock picker if you're going to pick individual stocks. And you have to be a pretty wise, understand the overview of a sector if you're going to do that. That's why we use outside managers to do a lot of that research and choose those sectors and find them for us, and we kind of piggyback on their expertise most of the time.
If you're just joining us, this is Premier Retirement with Jeff Vogan. Of course, Jeff Shade here talking with Jeff, and we've been talking about current events here, the Trump presidency, a little bit about tariffs and the stock market here in the month of December. If our conversation resonates with you, you're trying to get a head start on 2025, we invite you to call us here at 520-780-9059 and request your Premier Retirement Roadmap. No cost, no obligation for this. It's an opportunity for you to sit down with Jeff here before the end of the year, talk about your individual journey towards retirement, get any questions answered that you have. No cost, no obligation. Again, there's no judgment for this at all. 520-780-9059. You can make that call this weekend right now. Leave your name, telephone number. Shelley will call you back during the week and set up that appointment for you. Again, it's not going to cost you a dime. 520-780-9059 to request your Premier Retirement Roadmap. This one call really could make all the difference. Jeff, you mentioned just a moment ago in the initial conversation about tariffs that Trump has threatened, and he said he could levy 25% tariffs on goods coming from Mexico and Canada, and he's thinking about charging an additional 10% tax on products from China above any additional tariffs that he may levy. How's that going to affect us as consumers, and will it affect us as investors?
Well, I don't think it's going to be as harsh as everybody's making it out to be. I think tariffs have always been, a way that Trump likes to negotiate business. Remember when he said, Mexico's going to pay for the wall? It wasn't because he's going to say, send us a check. We just built 20 feet of wall. We need another $10,000. It was, if you were going to start, raising your tariffs, we're going to raise your prices of all your imported goods. All those companies that moved to Mexico to manufacture because there was a free trade agreement. Sorry, we're undoing that. We're undoing NAFTA, and we're going to charge you now. So those extra taxes are what paid for the wall. So, when everybody says, oh, they never paid a dime for the wall. Well, they also paid for it by, having to house and, keep the border crosses on the other side, had to wait their turn and so forth. And so they had to remain in Mexico. That, saved a lot of the costs that we would otherwise had incurred. So, it is a negotiating tool that, hey, look, we'll raise them this much unless you don't do this. Or we better see a drop in fentanyl, in America, or we're going to keep raising your tariffs. China, quit sending it to Mexico and using that as a backdoor to come in because their tariffs are lower. We're going to just keep raising everything. If they don't put tariffs on Mexico and Canada, China isn't going to care about sending anything directly to us. They'll just send it to Canada and have Canada sell it to us and, keep that margin. And so they'll just do some backdoor deals. So I think from any direction that goods and services can get in here, there's got to be a tariff that applies to everything. And it has to be, I guess, in a way punitive enough so other countries will start, taking care of the problems that they're creating by just this free open border, not just with, illegal undocumented immigrants, but, just all the stuff that they bring in with them. Well, drugs and whatever else. The other thing is, when you're talking about a 10% tariff increase, oh, by the way, let's back up a little bit. When Trump raised tariffs and Biden got in office, if you look at the records, a lot of those tariffs actually were increased. He doubled down on some of that stuff. So it wasn't like, oh my gosh, the Republicans are the horrible people. Trump is bad. He made tariffs and that's what caused inflation. Not necessarily true. Now, if you say, well, Biden, raised tariffs too, and that's what caused inflation, not necessarily. The inflation was really caused not so much by the printing of money, which everybody says is the reason. That's only part of the reason. The other reason is that there's a supply chain interruption. If there was plenty of supply and the prices remained down and, there was no tariffs and everything was super cheap, everybody with all the extra money would have just had more to probably save and more to buy more stuff. The economy would have been clipping along really well. But the COVID really did more damage than just to teach the government how much they could control us or not control us. And I think we've kind of seen through that program and won't let it happen again, hopefully. But the supply chain interruptions were really what made the people with money able to buy stuff and the people without had to wait, right? And pretty soon, inflation becomes a real issue. The supply chain really has not been fixed even since then. If we notice during the Biden administration for the last 4 years, there's been a decrease in almost on a monthly or even quarterly basis, consistent of manufacturing going down in every sector in the U.S. that there is. And they've been favoring, because of the inflation and so forth, well, how can we buy it cheaper? We've got to buy it in other countries. So they're not manufacturing here. Well, a lot of those manufacturing jobs are really good paying jobs. They're not like a McDonald's fast food worker. These people are, high paying jobs. You can raise a family on one of the incomes in a manufacturing job, typically, management, sales, all that kind of stuff is decent, high paying jobs that generate a lot of economic benefit to Americans and America in general. AI is not going to take every job away from everybody, but I'll tell you what, if we don't have manufacturing, it's going to be hard to compete if they basically wipe out most of the service sector that, requires people. And now we can do everything with automated chat GPT or whatever for customer service, et cetera, et cetera. But the manufacturing jobs are the real hands-on jobs that we've lost so much of that we need to bring back. And if there's tariffs in the other countries and it does raise the cost of imported goods, there might be a number of companies that say, you know what, we might as well just make it here. If we can save, 10%, that's just basically right where our break-even margin is. They just made it more expensive now to buy from China. Now, does that hurt China economy? Well, maybe it does. Maybe they've got to figure a situation out. I mean, it's not our job to save the world and make every other country able to sell their stuff to us cheap so that our American population is out of work. And, pretty soon there's the haves and have-nots and a whole bunch of unemployed people that are have to rely on the government for their handouts. We want to have a successful economy where everybody here is able to work, raise their families, and to generate economic benefit. If we do that, we're happy to buy more goods from the countries outside because there'll be more abundance. It seems like certain politicians think that it's a zero-sum game. If somebody has more, we have to take it from them to give it to somebody else who has less. Why don't we allow everybody to have more and nobody has to have less? That situation can't exist. And, I think a lot of the Trump policies are going to create a better situation where that can't exist. I think it would have happened had COVID not shut everything down. It would have happened to a much more higher level than it did. I mean, we do know that during his first presidency, minorities had higher employment. More people were off, food stamps and other government programs. And then, of course, with COVID, we started getting, have to worry about stimulus and how to make sure everybody was okay during that period of time. So I don't know that we've really seen a good 4 years of what really can happen with good economic policies that create, I guess, an environment where we can, grow and thrive, where everybody can have a job and not only and raise a family on one job, not 2 or 3 jobs. Half these jobs that have been created supposedly by the government are second jobs or government jobs. And I don't even know if they really are real jobs. They're just the government paying people and taking money from, those people that are wealthy and still making a living and redistributing it. If taxes continue to go up, and we'll put this tariff thing in the same ball of wax as taxes, once you give that money to the government, it's kind of like a black hole. It just went someplace. If you put it back into business, it pays somebody to work. It pays somebody who works to pay their bills. The people they pay their bills to get money that they can spend. And it's just basically a repetitive cycle that dollar gets to turn over more and more times. And every time it turns over, somebody pays a tax on that. It actually raises more taxes than the dollars just being taken straight from the person. Now back to tariffs. If the tariffs are a 10% increase, and let's say we're selling a widget in America for $50, and we can buy it from China for $5, and the tariff right now is 20%, so now we're paying $6 for that widget. Do you think the companies that are selling it for $50 have to raise it to $60? I don't think so. I mean, they could raise it to 51 or, keep it at 50 and just sell more widgets because everybody can afford widgets. Maybe the cost of a good goes up, 10%, but it doesn't mean that the retail cost has to go up accordingly. The other thing is if it incents more people to start working and developing businesses in the U.S., that would create, more than enough economy to maybe create economies of scale or even competition where that widget can actually go down to $40 because they have to compete with the other companies that can make it here for less and charge $40 for it. So bottom line is we have to create a competitive market environment. Capitalism does work. Free market does work. It's been proven to work. More people are employed, more people thrive, more people gain wealth through that system than through the government to redistribution of wealth system, period. And there's no time in history or any company that you can show me where they tried to be socialist or communist or redistributed wealth, where that economy thrived more than America's thrived under the free market, capitalist program, where everybody's, able to compete. And if we can just get free stuff from China because, their people can live on $2 a day and, not have houses or anything because they can basically steal from their people and not give them a lifetime just in order for their country and their government to get wealthier, their country to seem like they're a dominant player in the, world of, goods and services. We don't have to prop that up. We can do that in our own country. We can make our own country great. And I think there's nothing wrong with that. I feel funny when people say, oh, the MAGA, they want to make America great. Yeah, don't you? Doesn't everybody want to make this? Sure. And that means we have to have our own economy. We have to, basically make competitors that wipe businesses out of America to compete on a fair level. And tariffs might do that. Or they can be used as a negotiating tool to get something that we want, maybe better control over fentanyl, drug trafficking, human trafficking, the cartel in Mexico, some of that stuff. Maybe we can somehow get it in order if other governments try to clamp down on it because they know that their economy is hurting because, we've got tariffs dangling over them that might, create less sales than they would otherwise get. If that's a big deal, if their economy is a big deal, maybe they'll stop some of the riffraff and the crap that's happening, in America that they're basically turning a blind eye to that's affecting us in a negative way.
We're talking with Jeff Oken of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Our show is called Premier Retirement. Again, if you'd like to get in and sit down with Jeff, talk about your individual situation, how the market and the economy, the new Trump presidency will affect you and your journey towards a confident retirement. We invite you to give us a call here at the firm. 520-780-9059 is our telephone number. Phone lines are open right now. That's the number that you'll use to request your Premier Retirement Roadmap. No cost for this. Absolutely no obligation. This is just a casual conversation between you and Jeff to answer any questions that you might have about your journey towards a confident retirement. Again, it's not going to cost you a dime, so make that call this weekend. Set up the appointment here before the year ends. 520-780-9059. You can also find out more about us online at premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we'll answer listener questions and more when our show continues on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We so much appreciate you joining us here each and every week for Premier Retirement on 790 KNST. My name is Jeff Shea, joined by Jeff Hogan. We're here for you each and every week for your fiscal fitness, your financial education to help you get to and through retirement. Once you get retired, we want you to stay retired. Also want to remind you that we're on 4 times a week for your convenience. Saturdays at 7 a.m., 9 a.m., and 1 p.m. Also Sundays at 11 a.m. And if you've missed any part of our program today, or if those times are not convenient for you, we're also a podcast. Go to wherever you get your podcast. Search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident and hopefully prosperous retirement. Jeff, every week we do listener questions. This week, no different. Richard is listening to us in Tucson. Richard writes, I'm 72, single, and I'm financially secure in my retirement. I have some stocks and real estate that I want to leave to my favorite charity. I want to know that some of my assets will benefit others long after I'm gone. Is there a charitable gifting strategy that you recommend, and how would I set this up?
Well, there's a few different ones that you could do. One is you can just leave the charity on as beneficiary on those accounts. Like if you have some stocks that, that's causing you a tax problem, they're just kind of buy and hold situations that you want to keep in your possession until you die and then hand them off to a charity. Then you could just put a pay on death account and just name the charity and let the charity know that, or let whoever's maybe in charge of your trust or your estate to know that, those are there for the charity and they can handle contacting the charity and giving them out. The reason I say you might want to keep them in your possession, I had a good friend that was the endowment counselor for Boy Scouts of America, and he had a lot of people that were, very, very cool with leaving a bunch of assets there. And he would set up a charitable remainder trust where they would actually give hundreds of millions of dollars in some cases. I mean, this guy raised billions of dollars for Boy Scouts. He was their lead endowment counselor for 20 or 30 years. He's retired now. But yeah, I remember, when they were in good favor and didn't have some of the problems where they had, abuse allegations and, when they started not delineate who could be leaders and who couldn't be leaders and what was a qualified leader and so forth. A lot of people, including like churches that, Lutherans and LDS Church would both use that kind of as their young men program with big donors, left it. And they are no longer a not a very good charity. I'm just leaving that as an example because I'm very, that's kind of close to me. I actually help people get set up with him. And, now they don't want to leave their money to that charity, but if they've already given it to them in a charitable remittance trust, they can't change their mind. Well, maybe now you've had some issues with the Cancer Foundation or Heart Fund, or you had an autistic grandchildren, and now you want to leave everything to the Autism Foundation, but you already left it to Boy Scouts thinking that was your favorite charity. So between the age of 72 and the time you die, you might change charities. So you might want to keep that charitable gifting strategy kind of close to your vest until you find out in the final days, and still have a choice of where to let that go or set that up for it. Now, you can also do, if you have some IRA type assets, many people are a little concerned that, if they leave a large IRA, and I've seen people that have, very large IRAs because they were able to either invest, some real estate in there, or maybe they bought Apple stock 30 years ago and never sold it and have tens of millions of dollars in an IRA, which is, not typical, but they're going to dump that in their children's laps and they have to liquidate it in 10 years. It's going to be all taxable. So, I mean, that could be money that you leave to a charity. You could even set it up in a charitable remainder trust where the charity only gets 10%, but you can actually pass it out over a period of much longer than 10 years on a tax favorable basis where you don't necessarily push your heirs into a higher tax bracket. If you just want to leave it completely to the charity, that's fine too. Then you get out of the income tax and you get out of the estate tax that's normally would be due on that account. So you could save, millions of dollars in estate and just income taxes by letting that IRA have the beneficiary XYZ charity. Or you could even set up a donor advised fund, or basically a self-directed charitable remainder trust, where you actually are, you have to set it aside. You can't, it's an irrevocable trust, but it's set up as a charitable remainder trust where you can actually decide who gets the assets at your discretion, or even at a charity, even at a trustee's discretion if you did it through a trust. So you can set these things up, not actually have to make the final decision until your final days, is, after you've scrutinized and know that in the next 10 or 20 or 30 years, the charity that you like now is still a charity you like. So you might want to leave some flexibility there rather than just give it away. The other thing is, if you want the charity to have an endowment now, and you want the tax deduction now, and you're comfortable with them now, I mean, you could transfer those assets at this point. I want you to be cautious, though, given the fact you're 72, and to some people that seems old, but in my business, I've acquired new clients that were 72, 30 years ago, and they're just barely gone, or they're still kicking, right? Mm-hmm. So you have to be careful that you don't give away too soon all those assets, or lose the benefit of using those assets should you need it. Some things, sometimes people set up a charitable annuity trust where they give money to a charity or a variety of charities, and that charity pays them an annuity, or basically all the interest, or a certain annuity that will more than cover your life expectancy needs for as long as you live. And then whatever's left, when you die, goes to the charity. That might be another way you can set it up. But there's plenty of ways to do it. You can go to a tax attorney or an estate planning attorney. They usually know how to do those things. The price is going to be pretty high, but you'll be more in control. Or you can go directly to the charity. There's people, and typically they have attorneys that are very savvy in tax planning and estate planning. They might be a little bit more interested, however, when they work for a charity, to make sure that you leave a bulk of it to them, or all of it to them if they're going to do the legal work. But most charities, if you've got a substantial asset base, if they just get a fair piece of it, they can do all of your estate planning, and they would do it at no charge, and they probably do a very good job with it. You might want to just get an outside, personal counsel, look at it to make sure that they're not self-dealing or leaving you hanging, or opening the door for some issue that you don't foresee now, but might in the future. But there's plenty of opportunities. You could even do donor advised funds, where you transfer some of those assets into a donor advised fund, get a tax deduction now while you're alive. Maybe you're selling some of your real estate and you have a big capital gain, but you want to offset it with a charitable gift. Maybe you don't necessarily want to give that money to the charity, but maybe you can just hand off some highly appreciated stocks. Guess what? You don't have to pay tax on those stocks when you sell them. You just give the highly appreciated stocks, and you get a tax write-off for the entire amount that you give to that charity. And that could be another play. There's so many situations. I mean, your question is a good one. It's very basic and generic compared to how many options there are and how many different things that you could do. I've done many of them with clients. There's so many out there. I don't even know all of them, but just kind of depending on how simple or how, complicated you want to make it, or, what charity you want to use and what kind of services that they might offer you. The big charities typically have very good, endowment counselors and lawyers that do a phenomenal job, and will do it at no cost to you if they're, included in some sort of, you could just do some of your gifting now and basically pay them for their services in that way. But, go explore it. I'd talk to your favorite charity first and say, hey, how do I leave this to you? What are some of my options that you would, take this favorably and not make it hard for me? And they might give you some options, and then, you can run them by somebody that, might be able to counsel you further, and either in the financial planning world that knows a little bit about charities, or in the legal world that knows something about estate planning.
Richard, we appreciate you listening to us in Tucson. Again, if you've got questions, we invite you to come in and sit down with Jeff. Call 520-780-9059. Shelley will set up an appointment for you. And again, we appreciate you listening to the program. Next question, Glenn is in Oro Valley. And Glenn writes, I'm 62 and plan to retire at 67. I'll have about $1 million saved in my 401k and some stocks. I'm worried about tax time bombs when I get into retirement. Is there anything I should be doing now to minimize my tax burden when I start taking withdrawals in 5 years?
Well, I think depending on if you have a pension or other income after you're 67, it might be, if you're in your final years of earnings between 62 and 67, I'm guessing you're probably in a reasonably high tax bracket, or one that would go higher if you were starting to convert $1 million over the next 5 years from your 401k into a Roth or a LERP or some other sort of a tax plan. If you are making maybe hundreds of thousands of dollars and more than you need, then maybe you could use some of that to actually pay the taxes and do some Roth conversions if it makes you feel happy. However, I think just based on this, I would say you might want to consider two things, again, including how much income you're making and how much of it you actually need. Whether you're married or single is probably, would direct the type of plan that we would want to focus on. If it doesn't put you into a higher tax bracket, you might want to continue to contribute to your 401k in a Roth portion, a Roth version, if they have it. Some companies won't match the Roth contributions because it's taxable to the company and they don't want to take that on. They would rather give you 401k contributions in a standard form, in the traditional form, so that they can get a tax write-off and you pay the taxes later on when you pull it out, or you pay it when you do the Roth conversion. So continue to make sure you max out anything that's maxed in that 401k. Consider maybe putting the rest in a Roth, or doing some things that would maybe set you up for a conversion plan, maybe over 2 or 3 years after you retire, maybe between the ages of 67 and 70, or 67 and 73, when you're old enough to take those required minutes. But actually, you're not going to have to take them out till age 75, I guess, at your age. So, we've got a lot of options after you retire to do conversions and pay taxes at a lower rate than you'll probably have to pay now if you did Roth conversions. But again, we have to look at the whole picture to see what your retirement roadmap would look like, and see if it makes sense to do some conversions or some Roth contributions now. You might already have a portion of your 401k that's a Roth. I mean, that might also indicate that you won't have a tax problem in retirement, because if you have Social Security, or maybe it's kind of minimal Social Security, and most of your assets are going to come out of a 401k. I mean, $1 million at $40,000 or $50,000 a year may not push you into a higher tax bracket than you're in right now. So we might not even want to worry about paying more tax now, so you pay less taxes later, because you may be already on track to pay less taxes later. Again, we have to do the math, look at it. I have a spreadsheet template that I usually put all the figures in, and let the math decide. Let the numbers tell us what makes the most sense.
Glenn, we appreciate you listening to us in Oro Valley. And, of course, we're going to send you out Jeff's book, Retirement: The Road Ahead. Again, you want to come in and sit down and talk to Jeff, 520-780-9059. That goes for anyone listening to the program today. There is no cost and no obligation for this. Once again, that telephone number, 520-780-9059. Make that call this weekend. Next question, Jeff. Marilyn's listening to us in Vail. Marilyn says, I'm a 77-year-old single woman. When I sell my house, I expect to net $300,000. I'll be living in a small condo that I already own. I'd like to know if there is a way to invest this money to assure myself of a steady $1,000 to $2,000 a month for the rest of my life. Would an immediate annuity be a good option?
Well, actually, an immediate annuity would be a good option, but I would do an income rider on a fixed indexed annuity, because they'll pay you more and you still have access to the balance of the account. What I mean by that is an immediate annuity is basically you put the $300,000 in there, and they'll probably pay you $20,000 a year for the rest of your life, or for a 10-year certain. Well, if you die in year 10 in a day, you only got $20,000 or $200,000 of your money back. If you lived to 97, then you got $400,000 of your money, and you actually made a little bit. Well, what if you put the $300,000 in an account that actually could grow at 7 or 8%, and you were able to take, in a year, you could start taking out $28,000 a year and still have the access to the benefit or access to the principal if you should need it. For example, in an immediate annuity, you go to a nursing home and all of a sudden your monthly expenses go to $8,000 a month, and $1,000 to $2,000 a month doesn't do anything for you anymore. Wouldn't it be nice if you only had a few years left to be able to tap into the $200,000 or $300,000 that might be left in that account? And by the way, if that account grows at, let's say, 6 or 7%, some of these track record is higher than that, with no risk to the principal. Let's just say it makes $20,000 a year in interest, but you're taking out 28. Maybe in 10 or 15 years, you've only drawn it down to 200,000. There's still a chunk of money left. You couldn't get it out of the immediate annuity, but you could get it out of an indexed annuity that has an income rider, because indexed annuities have no risk to principal, and they have much higher upside than a fixed interest like a CD or a short-term bond. The companies are willing to pay you a guaranteed payout much higher than on a fixed annuity, where they have an exact amount they have to pay you for a certain amount of time. They're going to lock that into a low interest rate and not worry about trying to, enhance or leverage your interest. On the indexed annuities, where you don't actually take an annuitized payout, in other words, you just take a guaranteed income, it's principal plus interest in some cases. But even if that annuity would run out to zero, they would still continue to pay you your, $2,000+ a month. So you'd actually get more from an index annuity with an income rider, knowing the ones that are out there that we use in our practice, compared to an immediate annuity. I mean, we do have some clients that want immediate annuities. They'll take maybe a 5 or a 10-year payout because they're trying to bridge a certain gap for a certain period of time, because they have other assets that are going to mature in 5 or 10 years that are going to either be maybe a pension that they're going to turn on, or a different annuity that they defer and then turn income on for the rest of their life. So, I do know the difference, and I do know that you're probably better served with something more flexible that lets you continue to keep control of the balance of the account should you need it, rather than something that basically you give away the $300,000, you'd never have access to it again. You just have that $1,000 to $2,000 a month for the rest of your life. So yes, it is doable if that's what you need and you could live on. but it doesn't offer the flexibility of products that I would suggest over and above what you just suggested.
Marilyn, thanks for listening to us in Vail. And of course, we'll send you out Jeff's book, Retirement, The Road Ahead. Call us here at the office, set up an appointment with Jeff if you want to discuss this further, 520-780-9059. If you've got a question you'd like us to answer on the air, you can get it to us by calling that number, 520-780-9059, or you can also go out to the website, premret.com, premret.com, and put your question in our contact form there. Of course, if we use it on the air, not only will you get a great answer, but you'll also get Jeff's book, Retirement, The Road Ahead. You're listening to Premier Retirement with Jeff Hogan. My name's Jeff Shade. Glad you could join us here on this last Saturday of November. Of course, after Thanksgiving, tomorrow is December 1st. And I want to also remind you once again that if you'd like to come in and sit down with Jeff here before the end of the year, we do have a few spots available. But of course, those are filling up pretty quickly. So if you'd like to talk to Jeff with no cost, no obligation, to get some questions answered for you so you can start 2025 off on the right foot, call us right now, 520-780-9059. Request your Premier Retirement Roadmap. No cost, no obligation for this whatsoever. 520-780-9059. Or also, again, you can contact us online at premret.com. Again, it is premret.com. Jeff, as I look at the calendar here, tomorrow, of course, December the 1st, and if I look at it a little more thoroughly here, it appears that we've got about 3 weeks if we exclude Christmas week and the 2 days before January 1st. So what are some of the things that we need to be thinking about at this time of the year in terms of things that we need to do before the year ends, and we've only got 3 weeks to do it?
Well, I think the biggest thing is just your tax planning needs to be done. Most people, know by December about what their final year-end income is going to be. And there's a lot of things that you should consider. One is, are you old enough to take required minimum distributions, and are you going to get it withdrawn from that account before the end of the year? Or have you taken a withdrawal or withdrawals over the last 12 months to more than overcome that? It seems like the majority of the people think that the required minimum distribution, which is the amount that the government forces you to take out of your IRAs, now the age is 73, but if you were in your 70s, you might have already had to start a few years ago when it was as early as 70 and a half. You turn that age, and that year you have to take out a certain portion. It starts around 4% of your IRA. Every year, that portion you have to take out gets higher and higher because it's based on your life expectancy. And the older you get, the less life expectancy you have left. So as you get older, you're forced to take more and more money out of your IRA, whether you need it or not. And, one of the things that we don't want you to do is, scrimp and save and have a boring lifestyle when you're in your 60s or 70s in the go-go years when you could be spending it because you're afraid to pay taxes. Sometimes it's good to pay taxes now on a little bit more money, because in the future you're going to have to pay more taxes on more money when you're not using it later. Anyway, so that's the discussion of the RMDs. I kind of got off on a planning tangent, but bottom line is we have to make sure that you're taking enough to appease the government of its requirement. And you can take it out of whatever asset you want to. If you have 4 IRAs, let's say you have a 401k, you got an annuity IRA and 2 other investment accounts, they all have IRA withdrawals because you're 70 and a half and you need to take the money out. Well, you can take it out of one. Let's say you have one that's super safe and the other one is a really long-term aggressive account and it's down for probably not this year, but maybe it is. Maybe you don't want to take it out of that account. You want to take it out of the safe account that went up 5% and didn't go down. So it's a good time to decide, hey, what account am I going to take the aggregate dollars that I'm forced to take out? And then once that's satisfied, what does that mean my taxable income is going to be for the year? And when you figure that out, say, okay, I'm in the 22% bracket and I've got 60,000 more that I could take out of my IRAs and only pay 22% tax on it. Well, 22% taxes is really the old 25% tax bracket, which I believe eventually will go back up to 25 or maybe even higher. So if you're in that tax bracket already, why not take the extra at 22 while it's still down to 22 and convert it to a Roth? So you can not only pay tax on the RMDs that you have to, go ahead and pay more taxes, because that account right now is probably less than it'll be in 10 years when you have to take a higher percentage out of more money. That way, now that you've taken it out and put it into a Roth and converted it, you don't have to pay taxes on that anymore, and you don't have to take RMDs out. You can continue to let it grow, compound annually, and then the heirs can get that money out tax-free. In fact, they can even let it defer and continue to grow tax-deferred for up to 10 years, just like a regular IRA, and then they do eventually have to pull it out. You can't multi-generation skip your Roth IRA to make it last multiple generations in a tax-free environment. You do have to pull it out, but it certainly lets you have a lot more growth potential, especially if you think your RMDs or your situation is going to land you in a higher tax bracket, or if just politicians are going to raise taxes eventually, that you might be in a higher tax bracket in the future. It's always best to pay taxes at a lower rate on less money than it is to pay taxes at a higher rate on more money. So a tax planning discussion is always appropriate. It should have been probably scheduled by October, November. And most of my clients have already come in for those tax planning visits, or they've got one scheduled sometime between now and Christmas time. It's really hard to try to make up the difference 2 or 3 days before the end of the year and say, oh, I should have taken this much, or oh, I want to convert this much. Guess what? A lot of these companies have limited staff because they're all out for the holidays, and sometimes things don't get processed in time. So, and besides that, I think your advisor might want a few easy days between Christmas and New Year's to relax with their family and do some fun stuff too. So, it's kind of rude to pin them to the wall 8-10 hours a day for last minute tax planning. I'm just saying, not that I have experience in that, but I do have experience in that, and I would prefer not to.
Yeah. So, Jeff, I know exactly what you're saying. But as I said, I was surprised. We've only got about 3 more weeks left in the year here to really do something. I want to talk about the people who own stocks here. I mean, 2024 has been a very good year for the stock market. But for all the stock market winners out there are also some losers. Some people may have bought Nike before they decided that, closing retail partners was a bad idea, or maybe Amazon before it announced the consumer economy was softening. So is it a good time before the end of the year to do what's called tax loss harvesting? And for those people who don't know what that is, can you explain that?
Well, if you need a tax loss to cover some gains. Now, the reason you would do tax loss harvesting in general would be, hey, I kind of want to take profits on my Amazon, but dang, I'm up, if I take profits, if I sell $100,000 of Amazon stock, it's doubled. I owe taxes on $50,000 of that. Now, thankfully, if it's in a non-qualified account and if you've had it more than a year, you've got a 15 or 20%, even to 10% tax bracket for those capital gains. However, you might say, yeah, but I still don't want to come up with $10,000 or $15,000 in, or $5,000 or $10,000 in taxes on this money. Maybe I've got a loser. Oh, hey, here's one. Gee, I had super micro and I had a ton of that. It went up to, went from $0 to $1 million, and now it's back down to close to zero again. I'm exaggerating, but if you have something that's, I might as well, I bought more when it was high. I bought it at $100 and now it's at 30. I'm not really sure they're going to get their act together. Maybe I can sell enough of that stock and take a loss that would offset, the losses on Amazon. You don't want to get totally out of Amazon, but you want to take some profits and maybe, write it out, but you don't want to have all of that exposed. You want to lock in some profits. You never get hurt taking a profit. Now, you could get hurt taking a loss because the market could go back up. But if it's a stock that maybe is overvalued already, kind of came down a little bit to more fair value, and think, gosh darn, I shouldn't have bought it that high, but oh well, it's probably going to take forever to get back. Might as well just take that and sell it now. Or if you have a dog stock, like you said, Nike's kind of taken some hits. Mm-hmm. Used to be a much better stock and a little bit more, appealing than it is with some of the recent announcements. I mean, Boeing's another one that, has had some trouble with that, 730 Max or whatever, the 737, doors blowing off and they got to fix a lot of problems. Maybe you're a little nervous about those companies. You want to, get out of some of those things and you have a small loss, maybe even some mutual funds that haven't been in good sectors. You can offset gains with losses, or you can just say, hey, you know what? I'm going to sell a house pretty soon. I haven't sold yet, but I'm going to need some losses. I'm going to take advantage of the strong market in December because I don't know what's going to happen next year. Let's take some losses now because I know I'm going to have profits in the future. I can at least roll those forward and use them for the the $200,000 I'm going to make on the sale of the house when it finally happens or whatever. I mean, you can actually plan tax losses, take them this year. You can write off some this year against any gains that you've made this year, but you can also carry them forward until you use them up. So, don't wait to sell till after you make the gain. If you think you can get out at a higher note than now, like if the stock is starting to go down, you think it could go down further, but you're scared to sell because you have a capital gain. Well, I'd rather sell it at a higher profit and pay capital gains taxes than say, oh, well, I'm going to wait till it goes down more so I don't have to pay a tax. I mean, that doesn't make sense. Although that mentality, believe it or not, does exist. Oh, I can't sell now. I've got a capital gain. Well, wait a minute. Why not sell now? It's the highest it's been ever. And the forward-looking guidance doesn't look very good in this particular industry. For example, if Trump bans the mandatory electric cars, no state can do it, even though California is going to, kick and scream doing it. But, if that mandate is basically reversed, then maybe electric car stocks or Rivian and Tesla aren't quite as attractive. You want to take advantage of it now before, we find out that they're making less profits than we expected or whatever. I mean, I'm just throwing an idea out there. I'm not saying that's a recommendation or that you shouldn't own Tesla stock. They've got a lot of things going good for them. And, Rivian looks like they're a great company. But so, I mean, I'm not making any, when I say a company, I'm just relating to, hey, there's different companies in the car business that may look really good now because of what was in place. And if we undo some of those policies, they might not look as good in the future. Why not sell out at a profit, pay the taxes? And if you have a dog that you want to sell to offset those losses, that's even better. The other thing you can do is just some last minute tax planning, tax gifting. You can set up a donor advised fund if you if you need a $50,000 tax write-off this year, put $50,000 in a charitable account where you've already given to your charity. So if you could give $10,000 a year out for the next 5 years, you've already got all the tax deductions now. And when you give $10,000 a year, you might not even hit that standard deduction for tax deductions anyway. So there's a lot of tax planning strategies you can do at the end of the year. It's time to think about it and get an advisor that understands tax strategies to help you.
Well, Jeff, we want people to have a relaxing weekend here, but remember, come Monday, you have effectively really only about 3 weeks. So listen to Jeff and get us started on some of the things that you need to take care of by the end of the year. Once again, our telephone number, 520-780-9059. Call us and set up an appointment for your retirement roadmap at no cost and no obligation. And again, our website, check us out, primrat.com. Jeff, out of time for this week. I'm going to thank you for your time, of course, but most importantly, I always thank our fine listeners here in the greater Tucson area for joining us. So for Jeff Ogan, I'm Jeff Shade. Have a great holiday weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.